Every year on budget day, we hear one line again and again. Government borrowing will be X lakh crore rupees. And immediately bond yields move, markets react, experts start debating fiscal discipline. But here's the real question. Why does the government need to borrow so much in the first place? And why is borrowing such a big part of the union budget? Let's break it down clearly. Government borrowing is basically a loan taken by the government when the government's tax income and non-tax income are not enough to meet its spending needs. It borrows money. This borrowing is shown under capital receipts in the budget. But how does the government borrow? By issuing government securities and treasury bills. In simple terms, when you buy a government bond, you're basically lending money to the government. The government borrows from multiple sources: the financial markets, small saving schemes, state provident funds, external assistance, short-term borrowings. But the largest share comes from market borrowing. This is also what mainly finances the fiscal deficit, the gap between what the government earns and what it spends. Borrowing allows the government to run welfare schemes, pay salaries and pensions, build infrastructure, keep essential public services running, especially during times when revenue collection is weak. In simple terms, borrowing helps the government continue spending even when income falls short. One big reason fiscal deficit becomes difficult to control is interest payments on past loans. When borrowing goes beyond planned levels, interest payments rise. Future budgets come under pressure. Fiscal targets become harder to meet. So today's borrowing doesn't just affect this year, it affects many years ahead. So does high borrowing hurt the economy? Yes, it can through two major channels. First, when the government borrows heavily from the market, there's less money available for private companies to borrow. This is called crowding out. Second, heavy borrowing pushes up interest rates. High rates mean costlier loans for businesses, higher EMIs for consumers, slower investment and growth. At the same time, the government itself has to pay more interest on its debt. India follows a structured borrowing calendar. One part of the borrowing plan is announced during the budget. The second phase usually starts around September or October. Funds are raised through weekly auctions spread across nearly 20 weeks. These borrowings use securities with maturities ranging from 3 years to 40 years. State governments also follow a similar process, but they borrow on a quarterly basis. So why is borrowing such a big part of the union budget? Because borrowing keeps government spending running, supports the economy during revenue shortfalls. But it also creates long-term pressure through interest costs. So as Budget 2026 is just a week away, what do you expect from it? Let us know in the comments section below.